Hello, in this video, we're focusing on the practical concepts that you can actually apply in the real business world. Hope you enjoy it. Let's get on with it. Today, we're looking at Palantir, a tech company known for sparking strong opinions. It's unique because it doesn't fit neatly into common ways we measure tech companies' performance. One popular framework used to assess growth and profitability in software companies is called the rule of 40%. This rule suggests that a software company should balance growth and profit in a way that their combined percentage exceeds 40%. Palantir challenges this idea by operating differently, which makes it an interesting case study in how traditional frameworks may not always apply to innovative or complex businesses. As we go through this, you'll see why Palantir stands out and what that means for judging success in the tech world. In software and SaaS investing, the rule of 40% has become a widely accepted guideline because it balances growth and profitability by stating that a company's revenue growth percentage plus its annual EBITDA percentage should be at least 40%. This means fast-growing companies can have lower profit margins, while more mature companies can make up for slower growth with higher margins. Palantir Technologies, however, challenges this rule. Despite being profitable, growing, and generating cash in strong markets, its performance against this metric fluctuates significantly by quarter. Sometimes it surpasses the 40% mark, sometimes it falls short, making the rule of 40 a less reliable indicator for evaluating Palantir. This raises an important question about whether Palantir is an outlier breaking the rule, or if the rule of 40 itself may not fully apply to companies like Palantir. We will explore this paradox, discuss how business leaders can use the rule of 40 thoughtfully, and consider what Palantir's situation teaches us about the limits of popular financial frameworks. The rule of 40 helps us understand key aspects of SaaS companies by measuring operational efficiency, how scalable the business model is, the balance between growth and profitability, and how well capital is allocated in a way that appeals to investors. It's especially relevant for companies with recurring revenue, predictable costs, and where increases in production don't add much to cost, as is typical in SaaS businesses. The reason this rule works well is because it reflects the core economics of SaaS. Growth takes investment, profitability requires discipline, and successful companies need to manage both at the same time. However, this assumes a fairly standardized SaaS model, and that's where Palantir stands apart from what the rule normally expects. Palantir is unlike most SaaS companies because it operates where government, defense, and intelligence meet enterprise AI and complex data integration, often in mission-critical environments. This unique position creates three key paradoxes. First, even though Palantir's software enjoys very high gross margins, the costs to deploy their solutions are substantial. These deployments require significant engineering efforts, tailor-made integrations, and often drawn-out procurement processes, which means short-term profits can suffer despite strong long-term potential. Second, their revenue is uneven and contract-based, with large multi-year government deals that don't follow a smooth growth path, causing fluctuations in quarterly results and making traditional metrics like the rule of 40% less reliable. Finally, part of Palantir's improved profitability comes from a decrease in stock-based compensation expenses, which the rule of 40% doesn't separate from actual operational gains. This can result in the metric either overstating or understating the company's true performance, highlighting why standard benchmarks don't fully capture the nuances of Palantir's business model. The Palantir paradox highlights three key lessons for leaders to consider. First, frameworks like the rule of 40% are useful guides, but should not be treated as strict rules. Some companies, especially those with unique cost structures, long sales cycles, or complex deployment needs, will naturally deviate from such benchmarks. Second, it's crucial to understand the specific business model before applying any metric. A tool designed for typical SaaS businesses might not fit companies in fields like AI platforms, defense contracting, or hybrid software services. Leaders need to adapt frameworks thoughtfully to their unique context. Lastly, focusing on long-term unit economics can reveal strengths that simple metrics often miss. In Palantir's case, strong retention rates, customer expansion, high gross margins, and increasing automation point to sustainable economic value that the rule of 40% does not capture. This teaches us to look beyond surface level numbers and appreciate the deeper financial dynamics at play. Start by using trailing 12 months data because quarterly figures can bounce around due to contract timing, seasonality, or one-time events, and TTM helps smooth those out. Next, separate the government and commercial segments since they each have different economic profiles. Government contracts tend to grow slowly but have higher margins, while commercial deals usually grow faster but with lower margins. Calculate the rule of 40 for each segment individually, then adjust for stock-based compensation and one-time costs by using adjusted operating margin or cash flow margins like free cash flow margin, which provides a clearer understanding of operational health. Remember, the rule of 40 is meant to show long-term trends, so focus on tracking these metrics over time rather than looking at any single quarter. Finally, make sure to compare Palantir with the right peer group, including companies like Snowflake, Datadog, C3.ai, Accenture for its service mix, and defense tech firms rather than pure SaaS companies to get a meaningful assessment. Looking at real-world examples helps clarify how the rule of 40 applies differently across segments and companies. For Palantir's government business, revenue grows steadily around 10 to 15%, with margins often above 30%, leading to a strong and predictable rule of 40 score in the 45 to 50% range. On the other hand, their commercial segment experiences higher growth, between 20 and 40%, but lower margins due to onboarding costs. This causes more volatility, with the rule of 40 score fluctuating between 30 and 45, indicating improvement but less stability. Comparing Palantir to Snowflake reveals two distinct business models. Snowflake achieves rapid growth with negative margins but maintains a rule of 40 score often above 40%, while Palantir balances moderate growth with positive margins, showing more fluctuation in its score. Finally, service-heavy AI companies like C3.ai and Accenture face challenges with the rule of 40 because their deployments need significant human support, leading to uneven revenue recognition and margin improvements that don't come until they scale. Palantir fits into this pattern, blending software with complex service delivery, which affects how their performance metrics look through the rule of 40 lens. This shows that strong businesses can have very different financial profiles depending on their models and markets. The rule of 40 offers several clear benefits. It's simple and easy to understand, making it accessible for many users. It provides a balanced view by taking both growth and profitability into account, which is crucial when evaluating company health. This makes it a useful tool for benchmarking and comparing businesses within the same sector. Investors also appreciate how it helps assess a company's financial discipline, encouraging sustainable growth over the long term. However, there are some limitations to keep in mind. The rule of 40 can unfairly penalize businesses with long sales cycles or those combining software and services in their models. It may also distort results in companies with uneven or lumpy revenue streams and doesn't factor in a company's strategic importance or market position. Additionally, some firms might manipulate figures through accounting adjustments to appear more favorable. Palantir's unique business model highlights these weaknesses clearly, showing why it's important to use this rule thoughtfully rather than as a strict formula. Palantir's experience with the rule of 40 highlights that this framework has its limits, especially for companies operating in unique and complex environments. Palantir is not showing weakness by appearing to break the rule of 40. Instead, it demonstrates that traditional SaaS metrics don't fully capture the realities of businesses with long-term contracts, mission-critical deployments, and hybrid economics. The rule of 40 is still an important tool for balancing growth and profitability, but it should be a starting point for analysis, not a final judgment. Companies like Palantir with strong strategic advantages, high gross margins, and long-term customer relationships can succeed even when their numbers don't fit neatly within conventional metrics. Ultimately, this paradox teaches us that great companies often defy simple measurements, and real insight comes from understanding the detailed context behind the numbers. If you found this video useful, there's plenty of more business and finance videos on the channel that you'll enjoy watching and get great practical value from. In the meantime, thanks for watching.